Thank you very much, Kishorji, and thank you very much everybody at the CFA Society India for inviting me here and giving me the opportunity to host this session. I was quite nervous because last night we had this, pre-conference dinner, and I was discussing the topic with someone, and they told me that it's a professional audience, and I started getting quite nervous because till now I've been speaking to people who don't know much. Now we have to deliver content to people who are confused, so it's even more difficult. And at the same time, it's also an honor and a great responsibility to conduct this keynote session with Navneet Munot. Also, I think introducing him is also a challenge because you know him as much as I do. He's been the chairman of CFA Society India and a very dear and highly respected colleague in the asset management industry. As you all know, he is the managing director and CEO of one of the largest and prestigious brand names in the Indian mutual fund industry, HDFC Mutual Fund. Last 2 years, he's been CEO of HDFC Mutual Fund. Prior to HDFC, he had an illustrious stint for 14 years as executive director and CIO for SBI Mutual Fund. I have great respect for SBI Mutual Fund because extremely good performance under the leadership of Navneet across fixed income as well as equity funds. Before that, a short stint at Morgan Stanley, and before that, about 13 years with Birla Sun Life Asset Management. So that's a really great and long and successful track record in India's asset management industry. And as I said before, it's my pleasure and an honor to host this keynote session. Before inviting Navneet, just one disclaimer. I think very rightly, instead of making it a monologue, he has invited me to make it more conversational. So what I meant by disclaimer is that if there is anything which falls short in terms of the delivery, I think it will only be limited by my ability to put up the right questions. So with that, Navneet, thank you very much. So Navneet, right up, like Abhishek mentioned in the opening remarks, after 2.5 years is the first time that the CFA Society is able to organize this event, offline, more in person. And I think in the last 2.5 years, there have been more conversations on WhatsApp and Zoom calls and Teams calls, etc., which has also left all of us a lot of time to brood and introspect. And since you are addressing your colleagues after such a long time, at least in person, so what has changed according to you? And Kishore also mentioned, somebody said new normal. Please don't do that again. Kishore said it's new normal. So please remember. So what is the new normal? Like what have you learned in the last 2.5 years?
So first of all, great to be with my CFA family in person and with our wealth management community. We have lots of memories in this room over the last decade or so, and over the last 2.5 years. As we said, that the last event was India Investment Conference in January 2020, and then we have got collected here. On all those Zoom calls, the few of the sentences which used to get repeated quite often: "You are on mute," "This time is different," "This too shall pass." But of course, this has not only passed, but I think thanks to the resilience and the resolve of mankind, I think we displayed the best of human ingenuity. And over centuries, we have shown that in every crisis, humanity has never left an opportunity to not only learn from the crisis, but become better. I mean, you can go back in centuries, and this time, in fact, when we did the first event, the online event in the month of March 2020, I mean, I just mentioned and got lucky with that over the next couple of years, as we go through this pandemic and as we go through this challenge, we are going to see the best of science and the best of spirituality. We are going to see the best of human ingenuity. Because you go back in century, you see the early 20th century, the challenges that mankind faced were very, very similar, but that's when best of the inventions kind of happened. So in the last 2.5 years, a lot has happened, and as Lenin said that there are decades where nothing happens and there are days when decades happen. I think in last couple of quarters, we have seen decades that have happened. And how markets got it wrong, and you use the word confused, but that's what we are, right? In markets, confused all points in time. In February 2020, just weeks before the kind of global lockdown, the volatility across markets, equity market, global bond market, global commodities market, global currency market, was at a multi-year low. In some of the markets, it was a multi-decade low, which clearly means markets had no sense. I mean, of course, like our Nifty was at the highest level, and so were several of the other markets. Markets had no sense of what was coming. And we saw in the next 2 years or so, the worst health crisis of a century, the worst economic crisis of a century, like the number of countries that went through a recession. I mean, in India, we were not used to a recession the way we saw it. We saw one of the worst social crises, whether you look at Black Lives Matter or the rising inequality, etc. We saw one of the worst geopolitical crises, US-China, US-Iran, India-China, now we have the Russia-Ukraine. One of the worst climate crises, and you don't have to read the IPCC report. You can feel it every day, whichever part of the world you are living in. And with all of that, I think today we are here and celebrating several of the things that mankind has achieved. Of course, there's a lot that has been lost. Millions of lives have been lost, millions of jobs have been lost, but today I think the world is chugging along. And I'm sure I feel very positive about the future. So what we have learned is, like, as I said, that never lose hope. And when the going gets tough, the tough gets going. It was great to hear from Abhishek. I think in these challenging times, how the CFA society, the volunteers, kept the flag high and continued to spread the message. Finance must be for the ultimate good of the society. And it's great to see all of you. That's been the biggest learning.
So, I think one of the things which I can't help but remarking after listening to you is that if you're an investor, I mean, generally, if your belief is that human beings are the next dinosaur, then I don't think, because basically investing by nature and equity specifically
Optimism
is for optimists. And in my 24 years, I've been told convincingly at least 3-4 times by people that the world will come to an end. Fortunately, it didn't do so. But I think,
there's this saying, right? I mean, Ritika would know better that economists have predicted 10 out of the 4 or 5, I don't know what that number is, recessions.
Yeah. So, clearly, and if you see in the last, say, whatever 20 odd years that we are talking about, somehow a lot of these crises tend to emerge from the US, whether it was the tech bubble, unfortunately the terror attacks, the global financial crisis, so many things about quantitative easing and then tightening, and then, of course, the recent bout as well. I meet a lot of investors, and wherever I go, the most common question today is, what's your view on inflation? Are we going into a recession? So I always step back and then first of all, I tell those people, show me your passport. Are you Indian citizen or are you living in US? Because I think in our market, most people mentally seem to be living in the US. Unka recession, apna recession. Unki mandi, apni mandi, that type of thing. Where do you stand on this? What do you think? What is the implication of whatever is happening in US? And more importantly, how do you think it should impact us?
So we are in a world where, who said this? I think Professor Garrett or someone, and there are a lot of people who have used this term called radical uncertainty or extreme uncertainty, extreme unpredictability. And there are 3 distinct features of the world that we live in. Everything is unpredictable, everything is faster, and everything is questionable. So as I said that in 2 years back, who could have predicted, that we are heading for a recession, we move towards a reflation. Today people are talking about the recession. So everything is so uncertain. It's a cliche, we live in VUCA world, but we really live in a VUCA world. It's volatile, uncertain, complex, and ambiguous. Everything moves very faster. Think about it, in such a short period of time, the way pandemic spread to billions of people, the way, the policymakers reacted, the way the cycles have undergone a change. As I said, extremely low volatility, the highest volatility in decades, again, a very low volatility. We have seen bond yields moving to 0 and then again where they are. In equity market, multi-year low to a multi-year high. And oil prices, for example, where we were, and in futures, oil got traded below 0, right? In March or April of 2020. who could have thought that day that we would be talking about 120 within few quarters? So, I mean, whatever I say today, really maybe in few quarters, we could be discussing something different. What markets are discussing globally are the 3 R's: rates, recession, Russia. I mean, Russia could be like politics. Or the other way of putting it, last year I said there are 4 P's that you need to think about in 2022, pandemic, prices, policy, and politics. But I mean, if you know this known, known, and known, unknown, and unknown, unknown, pandemic is the known, known. It won't impact the market. Prices, I think that's like a known unknown, which way the inflation will move, given the supply shock that we had and the demand resurgence as it's coming, thanks to the opening up, as well as the huge stimulus. How the policymakers will react to it, that was like the known unknown. When they see the inflation coming back, would they be worried about the growth, or would they have to think about that this time is really different? In the last 40 years, particularly in the developed world, they have forgotten how to deal with a beast called inflation. But the last one was the real unknown unknown. That's the politics. And markets only get impacted by the unknown unknown, and that's what we have seen. So talking about the US, I think it's really different. If you put 2 charts next to each other, the US rates and the equity market or the global equity market, or maybe all the risk assets and the risk-free rate of return, and you take US Treasury as the risk-free rate of return, they are the mirror image of each other since 1981. Rates have fallen from 15% to 0 on this side, and you have seen the global risk assets moving like this. And in last several years, and people say since the global financial crisis, central banks thought that any crisis can be solved through monetary easing, forward guidance, quantitative easing, cutting the rates, etc. But this game has been on for several decades. I think it started in 80s. I mean, the whole SLN crisis, or whatever, the Brady bonds, etc., whether it was the Mexican crisis, whether it was the Russian crisis 98, Asian crisis, LTCM, tech bust in 2000, 9/11, global financial crisis, Euro crisis, and the pandemic, which again I think we took it to a different level altogether. Every time we thought that any challenge in the economy can be solved through the monetary policy, and it's done wonderfully well so far. But there has to be, at some point in time, it has to kind of end, and I think it's coming to an end. Central banks have realized, or maybe in the process of realization, that they are not the only game in town, and I'm talking of global central banks. I think credit to our central banks. I think they have always been very prudent and very conservative, because we had several bouts of inflation over the years. So my view is that I think in the US and maybe in the rest of the world, the best of that 40 years of central banks trying to sell that put option to every holder of a risk asset, I think that's coming to an end. And I think the metal of growth has to kind of shift over a period of time. Whether there'll be, I mean, we are technically in a recession if you look at the last 2 quarters of data in US. Europe is, I think, over the next few quarters would have challenge in terms of growth. China has slowed down. And putting all this together, maybe I think, yeah, good for India, because we will remain one of the fastest growing major economy in the world for quite some time. And this will have serious repercussion on the way we price assets. Because in the last several years, the main determinant of asset price has been the discounting rate, right? So think about it, that any time, I'm just a few days back, last Friday, payrolls data, US economy shows that the unemployment rate is at a multi-decade low, it's creating more jobs. And the markets doesn't cheer it that economy is creating jobs. Market is fearful, because that means Fed is going to be more hawkish. So over the last several years, we have been that kind of a period where a good data is like not good, because then central
banks
banks
all those jobs are being created in the economics field or in professional forecasting or something. Maybe they'll figure out later. So there's always this phase, like I think briefly we saw it in 2011-12 also, where every time if the economic data was strong, like you quoted, low unemployment. So if the economic data was strong, the equity markets cheered economic prospects.
Yeah.
And if the economic data was weak, the market celebrated probably benign or dovish Fed commentary. Do you think we'll go through that phase for some time now?
I think we are going to see a lot more normalization over a period of time, and maybe it's the fiscal policies globally, it's the innovation globally, and maybe I mean, some people call it the end of globalization as we know it, but I think to me it's the globalization of localization. I think people will move from hyper optimization of supply chain to a more reliable supply chain, which means that every country, every organization, every society will put more capacities. And also we have been in a world where, I mean, this is on a lighter as well as serious note. You might have heard this. Again, it's a cliche that we have been in a world where if you are rich, you get bailout. If you are rich, you get bailout. If you are poor, you get handout. If you are somewhere in the middle, you get left out. And that left out feeling over the last decade or so has manifested in variety of ways politically in different parts of the world. And maybe I think this is the class where maybe there was a time or maybe places where they got the fruits of the globalization, but there are parts of the world or parts of society which saw the negative aspect of the globalization, the way they got impacted, and real incomes haven't grown in for example, in US for middle class for a very, very long period of time. So that will lead to lots of policy changes, which in the interim may not be liked by the market, but in the longer term will be good for the market, will be good for the global economy. The kind of growth we are going to see is different than the kind of growth that we have seen.
It's interesting you say that because recently I read this book called The Great Demographic Reversal. And it basically says that the middle layer which you mentioned probably felt left out, because in some sense the induction of Eastern Europe into the working age, in the working population, China of course, and large parts of the globe, because probably there was a glut of working age population, and I think maybe in the next few years it will only be India and Africa. So I guess that globally the demographics is reversing, barring India and China maybe. And I think labor surplus might turn into a bit of shortage in certain parts of the world. So anyway, thanks for giving those ideas. I think that's a perfect segue into the next part, which I wanted to check with you or ask you. Somewhere you mentioned that countries, you said globalization of localization, which probably means that countries will look for, like you said, more reliable supply chains rather than the cheapest or more efficient or most optimized supply chains. And in some sense, that is also reflected in politics. When Mr. Trump started talking, people took him a little lightly. But eventually, in the last few years, series of events, we are ultimately seeing the world becoming more bilateral compared to multilateral, right? And instead of two poles, there are probably now multiple poles, which kind of mark the global landscape. India, hopefully, could be an equidistant or at least a less controversial pole in a multipolar world. So how do you see this shaping up? Where do you see India standing? And what do you think are the investment implications for these changes?
So talk about the US hegemony in the last century, even now, and maybe before that it was Europe or UK. It's very clear that the center of gravity is shifting towards east and from north to south. And you mentioned about where the demographic dividend is. It's in India as well as in Africa, maybe small parts of Latin America. And in the supply chains, where will they get shifted? So I think a large part of Asia, that's where the consumption is going to increase very substantially over the next several decades. I think large number of organizations would like to produce it, let's say in India, in Thailand, and Vietnam, Bangladesh, Korea, some of these countries. Maybe for Europe, over a period of time, there could be some bit of that outsourcing to Africa as Africa starts doing well. They have the demographic dividend and the resources, the overall political environment improves. And for US, it could also be parts of the Latin America. And I think within that, from an India's perspective, if you look at the geopolitics that you talked about, if you look at the other challenges in the world, I think India is in a very, very sweet spot. I mean, there are countries which are determined to grow. We are not only determined to grow, but we are destined to do well, and the destiny is helping us a lot. As I said, this whole center of gravity shifting, and we are exactly at the right place. The world would like to have somebody, a large democratic country, as a counterbalance on this part of Pacific, given the rising influence of China and the imperial ambitions that they have got, and of course it's an authoritarian regime. World would be very keen to take the lead by India in the other challenges that the world has. The world is facing a serious climate change, And India is the one which will grow so much over the next several decades and is going to be very resource intensive. When you grow from $2,000 to $5,000 and $10,000, 1.4 billion people is going to be very resource intensive. So we cannot grow exactly in the same manner China has grown or Europe has grown or US has grown, right? It has to be a different model. And that's why world has a lot of stake here. You talked about the demographics, right? So China has already aged and so is the rest of the world. I think India is the one which will be the biggest supplier of labor force to the world. And these are like English speaking or maybe the multi-language speaking. India produces more engineers than US and China put together. So you can imagine what we'll do in terms of, and this is a geopolitically realigned and digitally redesigned, democratically different world. And in this world, I think India is in a sweet spot. And it's a more than a coincidence that we'll be leading the G20 this year. And I think world badly needs somebody like India, which is a lot more a purposeful capitalism or a capitalism with conscience to lead in this century. So I think from that perspective, I feel very optimistic about India. I mean, this is for us to lose unless we do a self goal. The destiny looks very, very clear.
It's interesting you mentioned that India produces the largest number of engineers in the world. And I think I can tell you with personal experience that some of them become engineers by mistake also. Like I used to tell I will be an engineer.
I just heard.
No. When I was 3 years old, since then I used to tell, because it's somewhere ingrained in our subconscious mind. So I used to tell everybody I'll be an engineer since the time I was 3 years old. But when I was 3 years old, I used to think the guy who drives the engine of the train, he is called engineer. That's what I used to think. That's how I became engineer. So I hope most people are doing it for the right reasons. Mine was the wrong reason really. But moving on, when we talk about investing, when we talk about equities, Mr. Buffett's name always kind of pops up. And usually when he is asked that what is the secret of his success, he's a very humble man. He always says that I was born in the late 20s or somewhere thereabouts and invested in the US, in 40s, 50s and 60s. And that of course coincided with US becoming a superpower after the Second World War. So basically, in short, he gives entire or most of the credit for his success to being in the right place at the right time.
Absolutely,
yeah. You think some of that is going to happen with some of the people here? I mean, you think they're plain lucky or they're really good?
No, we are definitely lucky. And what is luck? Luck is your opportunity. I mean, your preparedness to grab opportunity when it's passing through you. I mean, in history, there have always been societies, there have always been countries, there have always been individuals where the opportunity passed through them, but they were not prepared all the time. I think we seem to be like fully prepared this time to take this opportunity, which has been kind of has come our
from
way.
Soot Boot Ki Sarkar, we've actually started refunding $1 billion. We've started bailing out companies. Big change.
No, I think from a reforms perspective over the last several years, there are three things that are required when a country moves from a developing country or a frontier to developing and developing to the developed country. You need to have rule of law, property rights, which kind of fosters investments, which fosters entrepreneurship, people's willingness to work hard because they know they will be well rewarded for that. The second thing you need is education and innovation. The third thing you need is a strong social security net. And on all of these three fronts, I think we are moving in the right direction. On the rule of law, in this audience, I don't have to talk about the reforms that we have carried out over the years. And I think in terms of the way entrepreneurship is getting developed, and it's not only about the number of unicorns. You travel across the country and you can feel it. The ease of doing business, the ease of living, I think all of that will help tremendously, and we have been like one of the best democracies in the world when you look around the world. In terms of education and innovation, which was like a big weakness for India historically, because we invest such an abysmal sum on education, particularly the primary education, for example, where China did a great job and they benefited from it, from the kind of like labor that they supplied to the world. I think we didn't do as great a job. I think our focus post-independence was on tertiary education, which is the result that you got the IITs and IIMs, and that's why Silicon Valley is now kind of run by the Indians, but it's changing now. Why I say that? I think the digital technology has given us a great opportunity to really leapfrog on innovation and education. So if you know how to operate a smartphone, you are educated. If you don't, then you are not. It's as simple as that. And I think we are really leapfrogging in terms of the education and innovation and our ability to, I think we passed from, let's say, the fixed line to mobile, from PC to a smartphone, from branch banking to UPI or mobile banking, so on and so forth. And the third social security net is which is underestimated. This is the biggest reform underway in India. And this is I call the India's UBI. India's UBI model is a free toilet, free LPG cylinder, free basic electricity, an LED bulb, Sukanya Samriddhi, whatever, Atal pension, your Ayushman Bharat, the basic necessities gets taken care of, and that will bring millions, that will give like millions of people who don't think about the tomorrow, start thinking about the tomorrow and investing. And I think that should keep us in good stead. And I think, as you rightly said, that Buffett keeps saying, I won the Avarian lottery. I think we have won the Avarian lottery. Unless, again, I repeat, we don't do a self-goal in history. There have been several movements over the last several centuries or decades where we did a self-goal and we didn't grab it. But it seems we are moving in the right direction. And I think if we remain in that, and if we continue to grow even at this rate, you can imagine where we would be in next 10, 20, 30 years. My friend Nilkant will tell you better in terms of numbers. I mean, even if we grow at this pace, given the over the next several years, relative to the world, where we would be.
I think the right thinking people in the world have enough stake in India now, and they have fewer choices now. So hopefully, we'll be prevented from making self goals. Let's put it that way.
Yeah.
Moving forward on to the next part, which I wanted to pick your mind on. So given all that we've discussed about the global order, the changes, the new normal, ultimately tomorrow morning the market will open and all of us better get to doing something. So coming to the next say 2 to 3 years, given where India is now, of course we've kind of discussed the landscape in which we are operating, and obviously the landscape matters to us. One of the things which I have seen is that globally the stock market is probably one. I mean, markets do get correlated. But ultimately, economies operate with various degrees of isolation or high or low correlation. So given what all we have discussed, what do you think about India's economy in these circumstances? And what's your medium-term sense of what we are likely to witness?
So 2-3 years, as I said earlier, that we are in a world where everything is unpredictable, everything is faster, everything is questionable. But I think a medium term, I mean, maybe saying the same thing in a different manner what I said earlier. So democracy, demographics, demand, and digitalization. These are such 4 powerful forces in favor of us today that from $2,000, we can relate ourselves to where US was in, let's say, 50s, 40s. Yeah, they would have been like $2,000 per capita. UK would have been like somewhere between 50s and 60s. Japan would have been sometime there, late 50s, early 60s. Korea, Taiwan would have been like in late 70s, early 80s. And China was just there 17, 18 years back. 2002, 3, they would have been like $2,000 per capita. And the factors that we talked about, the reforms that we have talked about, the revival of the investment cycle, I think the real estate cycle turning now, maybe I think if there is a global recession, it will impact our exports growth for some time. But I have a different view on the medium-term prospects of the global economy. It's going to be a very different set of growth, I think, which will be favorable to India. With the PLI and other things, I think the supply chain shifting or supply chain realignment, I think India benefits immensely from that. So all of these factors should keep us in good stead. One of the interesting things that has happened is, I think in this period, balance sheets have got repaired. I think in this cycle, like say from 2012, 13, when you go back, I think the state in which our balance sheets were the corporate balance sheet, the government balance sheet, and the financial sector balance sheets. I think the corporate balance sheet and the banking sector balance sheets have got hugely repaired. I think they are in one of the better shapes over a long period of time. The government's balance sheet, of course, because of the pandemic, I think the debt to GDP ratio has gone up, the deficit is running higher. But I think the intentions have been very clear. Throughout this pandemic, we have seen the government has been very, very focused on fiscal prudence. I think we didn't cut or threw the checks from helicopter the way some of the other countries did. And I think with the taxation reforms and digitalization, direct benefit transfer, focus on privatization, etc., over the next few years, we have a real chance of improving the fiscal balance sheet very substantially compared to where we are today, notwithstanding the near-term pressure. So from that perspective, balance sheets are in a good shape. Corporate sector has also done a lot of good work in terms of becoming a lot more nimble and agile, becoming a lot more leaner. As I said, balance sheet is one aspect, but even on the operations side, I think everybody has taken the full advantage of the challenges that they have seen in last few years of the adverse economic environment, as well as the pandemic, where they had to really innovate, where they had to think differently. I think all of that over the next few years should lead to continuation of rising corporate profits. So, I mean, if you ask me like a couple of years of view on the market, I think in like 4 things. The framework is macro, corporate profits, valuation, and liquidity, or liquidity and sentiment. So macro looks okay, notwithstanding the near-term pressure from the global geopolitics or global, maybe in case there is a deeper recession, or how are we going to see the inflation and rates panning out. But barring that, the domestic macro looks okay, more stable. On the profitability side, I think the new cycle has just started. On the valuation side, they become relatively more reasonable compared to where they were. And of course, it's linked with the profit growth expectations as well. And on the liquidity side, clearly domestic and the foreign investors, they have sold. But I think the domestic investors have been doing well. Flows have slowed down recently, but the structural trend of financialization of savings is very much intact. Sentiments, again, in the short run, it's impossible to predict. But I think from a medium-term perspective, as you said, that the world has a lot of stake in us. World will invest a lot more. They've invested $500 billion, $500 billion of FDI in last 7 or 8 years, large amount on the portfolio side as well. Of course, we have seen a massive outflow in the last 1 year, but the domestic investors have bought that. Over the next several years, I think from that framework perspective, it should be good. But again, I think the caveat would be, I said, who could have thought in February 20 that these are the challenges we are going to see in next few months? And the one thing I can say with certainty is like, this will be a lot more volatile, because this is a different world where we don't know that on, like, even if there is a small sneeze in the market where central banks will come and say that no, everything is fine and we'll take care. This is a different world, and that means a higher volatility.
So, I think, questions? Yes, thank you. So what I'm going to do, Navneet, is that, cognizant of time, we have some audience questions already lining up. So a couple of things, what I'm going to do is that 3 or 4 questions I'm going to ask you, which, maybe we can have quick and, the first reaction kind of responses. And I won't call it rapid fire, because that will be too cryptic and not doing justice to what you want to share with us. But maybe 3 or 4 quick questions, and then we'll move to what the audience is saying. But first when Kishore walked up, I thought the time is over. I got a bit intimidated and I lost my train of thoughts. So I'll be obliged if you continue with what you were saying, and then I'll come back to the questions.
No, as I said, that this is a different world where over the last several years, particularly post GFC, where, I mean, on a very lighter note, I used to write that central banks have been treating the hangover with more alcohol. I'm talking global central banks. Again, I repeat, I mean, RBI has been one of the most conservative, one of the most prudent central bank in the world. A lot of credit to them, but I think so markets have should get used to a different world now, when that put option may not be available in the same form or with the same vigor that it has been over a long period of time, where they've been always so focused on financial economy. And maybe I think the relationship between the financial economy and real economy became such that it was not the dog that was wagging the tail, it was the tail that was wagging the dog. I think we are going to see a different world over the next few decades, and that's why volatility structurally could be higher going forward, and we need to keep that in mind. And everything impacts us in a world of that unpredictability and faster, and also everything is questionable, where the information is moving at the speed of thought. It gets priced in, and the world has World has so much of financial leverage because leverage increased so much because of cheap liquidity supporting the markets. World has got so much of robo leverage because the machines have made things a lot faster in markets, and world has got so much of psychological leverage thanks to the social media and the pace at which the information moves, and all of three put together have created the different kind of markets than what the markets were several decades back. And then now we are in that whole transition phase where that particularly the financial leverage, which was supported by the easy liquidity, won't be there as we deal with the another beast called inflation, which I think globally central banks kind of didn't pay as much attention to for a very, very long time, and it's back. I think the market participants need to get prepared and prepare a lot better than just extrapolating all the models that you have developed over the last 10, 20 years.
So I think, to sum up a couple of learnings from whatever you've discussed, from the participants' perspective also, I think one thing which you said a couple of times over, which is that macros, and we're going to be in a very different landscape. I think one of the learnings, drawing upon what you spoke, has been obviously that one is very difficult to forecast macros. And second is, even if you are right in forecasting macros, very difficult to figure out what the market actually is going to do. So my sense is that, portfolio design, asset allocation, I think some of those things, the more strategic stuff is really going to matter, because I don't think you can ride every wave, or you cannot negotiate every bend in the road. But I think the portfolio construction and asset allocation eventually is going to matter a lot. And the second interesting thing which you mentioned, right at the beginning, was also about that, we felt that, COVID, the pandemic actually made us believe that, things are going to go haywire. But then you also mentioned about the human spirit and entrepreneurial talent. Recently I read this book called Alchemy, which is written by one of the founders of Ogilvy, Rory Sutherland. So he said that logic and science works very well with physics. But when it comes to complex adaptive systems like markets, then you need to believe in magic and emotion. So I think those things will, work very well if we probably keep these things, keep this in mind, right?
You talked about the Rory Sutherland, just slightly digressing. So it's a very interesting quote. The opposite of a good idea can also be a good idea.
Absolutely.
That's in the advertising context, but I think Professor Bakshi in one of our conference, I think, gave a presentation on that. It's very beautiful. Opposite of a good idea can also be a good idea. And whatever I said, I mean, particularly in India, somebody has put it very, very nicely that whatever you say about India, the opposite can be equally true. And whatever you say about like markets or the way we have discussed about the macro, you don't know in next few months, the opposite of that could be equally true. We are worried about higher oil prices. We really don't know in next few months which way the wind blows. But we have to keep in mind that this is really a very, very unpredictable, highly uncertain world, which way the oil prices will go, which way commodity prices will go, growth, inflation, central bank
It's quite
policy.
interesting. Are you a Bollywood fan by any chance?
Not so much.
It's quite interesting. You mentioned that anything you say about India, even the opposite is equally true. I can't give you credit for that statement because it's a very famous song from a movie called Fir Bhi Dil Hai Hindustani. आप उसका title song जरूर सुनिएगा.
Sure.
Right? So anyway, I told you that I'm going to ask you 2 or 3 quick questions and then move to the audience questions. So first is, there's a lot of talk about the new age investor and, markets falling, investors not getting scared, money coming in, domestic flow, etc. What's your quick and dirty read about this?
So they are more informed, they are more intrigued, they are more intense, they are more interactive as investors, and this is on a very lighter note, and don't quote me anywhere. For the young investors, sometimes they think investing is another form of entertainment, but it is not. It's a serious business, and you put it so rightly. Ashish has been a deep thinker. That while we have talked about changing macros, changing global environment, changing domestic environment, changing market environment, but the fundamental tenets of investing never change, right? It's about setting your investment objectives, asset allocation, diversification, rebalancing. I think all of those don't change, they won't change, but there would be like newer trends. I talked about that leverage, robo-leverage, and psychological leverage. Maybe I think, yeah, the new youngsters who have come into the market, I think they have a different view about the world. They have a different way of dealing with the world. And maybe every generation was like that. Maybe when we were young, we were thinking differently about the previous generation. I always believe the next generation is smarter than the previous generation. So I think they are smarter. So their worldview on DeFi and all, only time will tell in which way kind of it turns out. A lot of people, I mean, after the tech bust, a lot of people made fun of the entire, the internet boom. But it's the internet which kind of kept us in good shape during the pandemic, or I think internet has really changed the world in a meaningful manner, while several of those companies didn't survive. So it could be similar, I mean, just to kind of talk about the millennials. So maybe the crypto, as we know about the currency, may or may not, I don't know the future of that, but if you don't know, the blockchain technology can also be a powerful force like internet, and we don't know in which way it will manifest in changing our lives or the way we think about the world. So I have a lot of respect for them, and I think we should always be kind of keep looking at them in the way they are behaving, and I'm sure there would be learnings instead of just kind of like laughing at them in terms of, let's say, the meme stocks or what they are doing on cryptocurrencies or some of the other things.
Yeah, I think, one of my learnings is that never assume that the other guy doesn't know what he's doing.
Yeah.
I think that's where we all get trapped. So anyway, what I'll do is, in the interest of time and doing justice to the audience, patience with us, I'll take up the audience questions. I think the first one is there a bear case for India? Why are foreigners taking money off the table?
No, as I said that, we are part of the world. Of course, so historically we used to be a high beta risk asset. We always danced to the tune of global liquidity, global central bank policies, global sentiments. So if there's a risk on in the world, emerging markets go up, all risk assets go up, India also goes up. If the world is going down, we were also going down. We were last 25, 30 years, I think if the US markets, sneezed, we got a fever. But thanks to the financialization of savings in India, this time the impact was a lot lesser than what we have seen historically. Foreigners are selling for their own reasons. Maybe the money is moving from risk assets to risk-free assets. Maybe the US rates have gone up. There are outflows from emerging markets. India's weight had gone up from like 8% to 12, 13% or so. And relatively, valuations in India appear higher than some of the other countries that they have a choice to invest in, and there could be a reallocation of that money. But I think, I don't think that they are bearish on India because they think macro environment is not favorable. Maybe I think it's a relative valuation call between asset classes and between the emerging market asset itself.
When you talk about spirituality, you are always taught that all the answers are within. Look for answers within yourself. I always tell my investors that when you don't apply that logic to the stock market, because every time foreigners are selling, don't start looking for reasons within India. Just to add data to what Navneet said, more than 70% of the money which comes to India is non-dedicated. Money which comes from global equity, global emerging market, BRICS, Asian equity, etc., etc. So I think when people are selling all over the world, they might end up selling in India unintentionally. If you sell a global emerging markets fund, you end up withdrawing $15, $20 from India unintentionally. And the other important thing is that India is not yet a single country asset class. Hopefully in future, we will probably get there.
So single country asset class has been like out of favor other than, let's say, US and some of the developed countries. I think the bulk of the allocation would have been to, let's say, emerging market funds, or if somebody wanted to participate in Asia ex-Japan, or maybe allocation, as you said, from global equities fund, global small cap fund, etc. I don't know, it may sound like a wish list, but maybe I think looking at the world, and you cannot have this like whole emerging market in one single basket. And most of these acronyms, whether it was the BRICS and all, I think that's not the right way of investing. Over a period of time, and again I repeat the sentence, if we don't do a self goal and the macro, the framework that I talked about earlier, we continue to move in that direction, over a period of time there is a possibility that a lot of investors globally will think that instead of putting money in emerging markets, because then you have, let's say, half the market is China, Korea and Taiwan, right? If you look at the emerging market index, which is like a lot more linked with what happens in US or maybe certain sectors. I think the best way to play is like maybe allocate some money to India, that time, yeah, things may undergo a change, but that's quite some time away. I think in the very near future, if money is moving out from emerging markets and within that our valuations are relatively higher, I think, yeah, there have been outflows.
Maybe
Of
it's
course,
just
in the last few weeks it has changed, but we are talking more medium term.
and and maybe maybe I'm just talking a fraction, but say for example, within White Oak, within the group we are a FPI, and we are obviously a single country FPI. But I can say even from first
Kishore
Jan
will
till
charge
date.
the sponsorship fee for the name just you took.
No, oh, so
I'm just
sorry.
kidding.
I will not tell you. I will not tell you where I work, but I will say from first Jan till now we are net positive on flows. I was just saying that as a single country we are net positive on flows. Just the second question: do you think India is growing sustainably, or do you see India having issues similar to China in future? This question is with respect to environment and socio-economic issues.
That's a great question, and it's credit to our leadership, credit to this country, credit to our civilizational heritage. I always say this, when the world teaches us ESG, I think we don't have to, I mean, of course, there is a lot that we can learn from the other parts of the world, but I think our civilizational heritage teaches us a lot about ESG. We are a civilization and a society which always believed in Bahujan Hitai, Bahujan Sikhai. We always believed in not borrowing from the nature. I think we have always believed in circular economy as a society. And at this stage of growth where you are at $2,000 per capita, when you have tens of millions of people in abject poverty, when you have such a difficult terrain as a geography, and at this stage, India takes the leadership, whether it was COP, whatever in Paris, or whether it was in Glasgow, and say that, no, we want to lead from the front in terms of having a sustainable model of growth. We're talking about whether it's the solar energy or the wind energy, renewable energy, or the green hydrogen, or whether in terms of the EVs. I mean, look at across sectors, whether it's a sustainable agriculture, sustainable transportation, sustainable, the manufacturing. I think it's a credit to our society. So there are challenges, no doubt about it. Unfortunately, we have to deal with it at this stage of the growth. The other countries didn't pay attention to it, right? I mean, they damaged the environment so badly that the humanity is paying a price. But I think India is following a very, very different model. And again, I mean, destiny can help us in terms of some of the innovations that are happening. Maybe who knows that India will have a very different way of producing the economic growth or creating a sustainable and more equitable growth than all the other economies in the world have shown so far. That's why I keep using this sentence. I think India is creating an economic miracle which is unparalleled in human history.
In fact, there is already data to prove that the oil intensity of our growth is, I think, 40% lower than what it was 10 years back. And obviously, we are investing. I think one of the benefits of developing late is that you will not go through what everybody else has.
So the leapfrog that we had, which you talked about, fixed line to mobile, or let's say from PC to smartphone, or branch banking to mobile banking, and in so many other spheres, even in, let's say, the new age of manufacturing, it could be quite different for India. Maybe the agriculture, the way we will produce could be quite different, learning from some of the recent innovations.
The next question is, it's about the much hyped commodity super cycle. How will it be factored in by markets given the requirements of new energy resources like lithium, for example?
Yeah, so on commodity super cycle, so over the last, I think, couple of
like lithium for EV segment, sorry.
Yeah, so over the last, particularly the post-global financial crisis, I think we haven't seen investments in real things. I mean, you haven't seen a lot of new investments in for example, materials for a variety of reasons, including the ESG, the environmental concerns. Also, large part of the money was going to the so-called new economy. So innovation was coming with an interesting app and not really producing something real. And that's why suddenly we are seeing that a lot of supply disruptions in the deglobalization and the after effects of the pandemic and the trade war between US, China, the whole Russia-Ukraine crisis. I mean, that's like a large pocket of energy and the grain exports, etc. the world is seeing this. There are like two aspects to it. One aspect is that, of course, in the very near term, we have seen the prices spiking and the inflation rearing its head. Of course, in last few months, they have all softened quite a bit thanks to the demand normalization as well as maybe the supply augmentation that has happened. But structurally, I think prices stay higher than the earlier cycle, which is not a bad thing because that is something that will lead to more investments and more innovation. If oil stays at these levels and of course you put together the climate change, I think over a period of time more innovation will happen. And same is the case with the materials. I think copper is like Dr. Copper, as people in the market say. I think all these, whatever we are talking about, the renewable energy or the EVs, etc., several of these materials, and of course the materials like lithium, etc., I think will be needed. So one area apart from the healthcare, I think when we think about the technology, and Abhishek in the opening remarks talked about like a lot of these, the industrial revolution, before that the agriculture revolution, the information revolution, and all of that. I think next few years in technology, healthcare is one, and even in the material sciences, a lot of innovation is needed. We haven't really done much for decades there. That could be like, those could be the real areas of some path-breaking innovations, and world badly needs that. That's where logically money should be moving and not in those like, creating the next best app to order something in 10 minutes.
So the last audience question, this is someone soliciting your views on a couple of key issues in their view. One is, what's your view on the exodus of top talent from India due to various reasons?
This hall is full and this is the real talent in India. I feel so positive about the prospects of financial services. I mean, there are like tens of thousands of people working for global giants in India doing all kinds of things, right from trade settlement, risk management, compliance, reporting, research, I think all kinds of things over a period of time, maybe with the gift city and other things. I think as we become a larger part of the global economy, global capital markets, and the regulation continues to remain conducive, it could be like the next big financial center. Look at variety of other spheres in India. We talked about the number of engineers. There is shortage, right? I mean, of course, there could be like a talent exodus. Maybe I think some of the business families may have looked at an alternative on their citizenship, but otherwise, I think, yeah, this is where the bedrock of like real, I would say, the talent which is coming up across spheres. I think we are producing the highest number of engineers in the world, highest number of CFA candidates in the world who will be the charter holders over a period of time and will do wonders to the global financial system. Highest, I mean, across spheres, healthcare and teachers. We would be the teachers of the world. We would be the healthcare professionals of the world. We would be the traders and the financial services, wealth managers of the world. So I don't feel negative on. In fact, one thing that India should surely do, you go to Silicon Valley, you go to the Wall Street, you go to US universities, you go to like US research organizations, or most of the other parts of the world as well. You see lots of Indians now in position of power. I think we should really work hard to get a lot of this talent to come and contribute to the society, not only by cutting a check to an NGO, but coming here and creating things here.
Yeah, I think
there should be a like big national program on that. How do we get that talent back in India? Can't we create those universities where those professors come and work? There are these FLAME and some of the universities which are doing a great job. I'm sure over a period of time, more and more people will do that. I think some people are opening up outstanding healthcare institutions. We should attract more talent on that side. We should attract talent on the technology side. We should attract talent on like almost every sphere.
I would just say that usage of the word exodus is a bit strong, because if it's giving us soft power, political power, financial power, and adding to our influence, then I don't think it's going to be bad.
We are 18% of humanity, and because we were a poor country, and maybe the way the world was, I think the way world is shaping up now, and with 18% of humanity, and we are kind of respected as people who are intellectuals, people who are thinkers, people who think about the planet and its future, will be respected very differently going forward, very, very differently. And if you are 18%, then as someone said that everywhere you go up 5th or 6% should be the Indian, right?
Absolutely. So maybe quick 2-3 questions. It'll help if we can get very short and quick answers. So with interest rates, especially, I mean, the references to risk-free rates going higher than they were for the last 4 decades. Where will a traditional global 60-40 portfolio go? And what will it mean for India in terms of global asset allocation?
So, I mean, the answer would be different for Indian investor and global investors. See, global investor in this whole 60-40, where I said that, I mean, rates fell, they had to take higher risk to deliver those depending on which endowment or which pension fund, and your liability side, even if you had to earn 5, 6, 7%, you had to take higher and higher and higher risk to get those returns, right? Because rates were zero, and as Mangar says, I mean, rates is like that gravity to the apple.
Yeah.
And maybe I think when rates go up, that undergoes a change. But we have to keep in mind one thing. Given the level of public debt in the world, central banks and policymakers will have no option but to keep real rates in negative territory, which makes it like very, very challenging for the global, the investing
So
community.
staying with central banks, what's your view? Why is it that there are extreme economic events happening more frequently in the last 2 decades? Is it because central banks are not able to manage policy better?
No, I think they've actually lessened the impact of those extreme events on the markets, because markets have got used to this, as I said, the put option from the central banks. If let's say you remember those PIGS countries, Portugal, Ireland, Italy, Greece, and Spain, where I think it was very difficult for an economist to think about how they will get bailed out, looking at the level of debt and the situation of the financial sector. But I think the 3 words, we will do whatever it takes, 6 words or whatever, 7 words, changed everything, and the bond yields fell from 18-20% to like 0 or less than 0. At one point in time, $17-18 trillion worth of bonds were trading close to 0 or below 0. So I think they actually lessened the impact of, or maybe the pain of, let's say, whatever was happening in the real economy or the real world, whether it's a geopolitical or a social event or an economic event. It did not kind of.
Yeah, in fact, they've acted like, those opera conductors, when they sway the hand, that's how the music kind of, so they've probably orchestrated
It's also
it.
because I think the world has changed, where the size of financial economy relative to the real economy has gone up so much, and that's what I talked about, the leverage plus robo-leverage plus the psychological leverage. But I think we are in that transition over the next several years. Let's see how it pans out.
Yeah, so I deliberately kept the toughest question for the last.
Oh, they were not tough, all these?
नहीं आप थोड़ा पानी वानी पी लो सोच लो, it's very difficult. How to exit stocks at 52-week high?
Sorry?
I told you, you're buying time by saying sorry and all. These are, professional speakers are trained like this. If you don't know what the answer is, you say, can you come again? Or, ऐसा किया ना आपने. How to exit stocks at 52 weeks high and how to buy at 52-week low.
I wish I knew it.
नहीं जवाब तो देना पड़ेगा.
Yeah, so I think if the stock is India, let's say, it always makes that another 52-week high. If you miss that, the earlier 52-week high, you can be rest assured there'll be another 52-week high. So in February 2000, just around our India investment conference where we met in this room, Nifty was at 12,000. In the month of March, I think around 23rd or 24th, that's when we started doing our virtual events. It touched a low of 7,700, right? So you missed that high, but then automatically you got another high today.
Most people have heard Mirza Ghalib, so they can relate to, दिल के खुश रखने को गालिब ये ख्याल भी अच्छा है. But anyway,
it's good for your wealth also.
So इसका जवाब नहीं है. Should we end with that?
No, I don't think that you can. I mean, I'm sure there could be a few people who can do that, and if you are, for every trade there are 2 people, right? I mean, so there is somebody who has a different view than yours. That's how the market is. I think if somebody is thinking it's a 52-week high and this is a peak, I should sell, there has to be another person, who thinks that no, it's going to get higher, and that's what gives the beauty to the market, and that's what I think we get for a living.
If I can just add one thing, I think most...
You know, I'll put it
Please.
slightly differently, and I won't take the name of the AMC because then, as I said, they will charge the sponsorship fee. But we have put it like very, very nicely, and I'm going to put that on the visiting card of like every employee of the company. Wealth creation equal to, because there are all like wealth managers, wealth creation equal to sound investment plus time plus patience. Sound investment plus time plus patience. There is no another formula. There is only one formula for a sustained wealth creation over a long period of time, and it's important to pay attention to that rather than trying to get everything at 52-week high or 52-week low. That's easier said than done.
There's just one summation, complementing what Navneet has mentioned. I think when you ask this question, you are thinking of your investment in start-stop terms. Whereas most professional managers and hopefully investors also, you should be focused on beating the asset class or you should be focused on beating the benchmark. If you think stop-start terms, that's when you think that this stock should go at 52-week high and the next one should come in at 52-week low. I don't think that eventually matters. But it's been a great honor, Navneet. Thank you very much for talking to me and giving me the opportunity. Thank you very much.
Thank you.